You ever open a rent renewal email and feel your stomach drop? Due to market conditions, your rent will increase by $400. Same four walls, same creaky floor, same broken blinds they never fixed. But now it costs more to exist. You scroll through your budget like you're defusing a bomb. Groceries, already slashed. Streaming, gone. Weekend plans? What plans? We move farther out, get roommates, cook everything, and somehow it still tightens. It's like renting became a subscription you can't cancel. Same product, higher price, every year. And if it's not improving, who's actually winning? You've probably heard it 100 times. It's just supply and demand. We didn't build enough housing. That's true, but it's not the whole story. Over 75% of residential land in major US cities is zoned for single-family homes only. In Los Angeles, it's 94%. That means on most city land, you're allowed to build one house, but not a duplex, not a triplex, not a small apartment building. You can build a 5,000 square foot mansion, but you can't build two modest homes on the same lot. So we fight over the same few apartments like it's musical chairs. We complain about high rent, then we make it illegal to build the cheaper options. And then there's developers. Developers don't build what people need. They build what returns the highest margin. Luxury units pencil out better than starter apartments. So we get glass towers with rooftop pools, while regular units disappear. Housing didn't just get scarce, it got turned into a premium product and priced like one. And once housing becomes a premium product, the corporate sharks show up. After the 2008 crash, millions of homes went into foreclosure. Wall Street didn't hesitate. Private equity firms stepped in and bought entire neighborhoods at a discount. Invitation Homes, one of the largest corporate landlords, now owns over 80,000 single-family rental homes. By 2030, institutional investors are projected to own up to 40% of single-family rentals in some markets. That changes everything. Because when your landlord is a person, rent might go up because taxes did. When your landlord is a publicly traded corporation, rent goes up because the spreadsheet says it can. One internal document describes something called the renewal lift. That's the strategy of raising rent on existing tenants just because data shows most renters won't move. Moving is expensive, disruptive, risky. So they raise the rent because statistically, you'll swallow it. They don't need 100% occupancy. They need yield. And that's where the old ladder starts to break. The old path was simple. Rent, save, buy. That was the ladder. Now, rent, try to save, watch prices climb faster than your savings. Get priced out, rent again. Home prices rose over 40% from 2020 to 2022 alone. Mortgage rates doubled. The median down payment for a starter home is now around $26,000. We get a raise and for 5 minutes we feel like we can breathe. Like, okay, we're finally climbing. Then rent renews, car insurance jumps, groceries creep again, and the raise evaporates before it even hits the account. Most renters don't have 26 grand lying around in savings. Many don't have it in available credit. And builders? They stopped building starter homes. They're not profitable enough. Instead, we get build-to-rent neighborhoods, entire developments where no one owns anything. Rows of identical houses, all leased. Then Airbnb happened. In cities like Lisbon and Barcelona, up to 1 in 4 apartments are now short-term rentals. In parts of New York, landlords evicted long-term tenants just to relist units on Airbnb at triple the nightly rate. A 2023 study found Airbnb expansion responsible for up to 20% of rent increases in some markets. Think about that. Housing meant for residents gets converted into hotel inventory. Tourists stay for the weekend. Locals lose the lease. That's when the neighborhood changes in a way you can actually feel. The faces rotate, the leases get shorter, the prices start chasing nightly rates, and suddenly we're competing with travelers for a place to sleep on a random Tuesday like it's a holiday weekend. And while all of this is happening, wages didn't show up. In 1980, average rent was about $300 per month. Adjusted for inflation, that's roughly $1,100 today. Current national average? Around $2,050. That's a doubling after inflation. Between 2001 and 2021, rent outpaced wages in 49 out of 50 major US metros. In Miami, rent rose 163%. Incomes? Around 33%. They used to say keep rent under 30% of your income. Now, roughly half of renters spend more than that. Many spend over 40%. At that point, rent isn't a bill anymore. It's a financial chokehold because once it takes first priority, everything else starts fighting over scraps. And here's what no one says out loud: rents follow interest rates, refinancing cycles, and investor return targets. Maintenance is the footnote. Large landlords finance properties with loans. Those loans are bundled into securities. Those securities are sold to investors. Your $2,000 red check? It doesn't just pay for plumbing, it services debt, it feeds dividends, it supports bond performance. Rental portfolios are now securitized, packaged, and traded, just like mortgage bonds before 2008. The stuff that got bundled up, sold as safe, and then blew up when the math broke. The building gets treated like a financial instrument first, housing second. So they don't raise rent because pay costs more. They raise rent because the model demands growth. And the model assumes you have nowhere else to go. We show up, we do the work, and the harder it gets, the more dependable we become. Stable renters, trapped customers. This isn't an accident. It's the business model.
Hey, if you like this, episode 3 is how banks screw us with our own money.